Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Introduction to Risk Assessment Concepts. Risk assessment is a critical component in the field of risk management, serving as the foundation for identifying, analyzing, and prioritizing potential risks that could impact an organization. Understanding the core concepts of risk assessment is essential for developing effective strategies to mitigate these risks, ensuring both the stability and resilience of an organization. This lesson aims to provide an in-depth introduction to the fundamental principles and methodologies of risk assessment, contextualized within the broader framework of analytical approaches to risk management. At its core, risk assessment involves three primary steps: risk identification, risk analysis, and risk evaluation. Risk identification is the process of recognizing potential hazards that could negatively affect an organization. This step requires a systematic approach to uncover all possible risks, which can stem from various sources, including financial uncertainties, legal liabilities, strategic management errors, accidents, and natural disasters. For instance, a technology firm might identify risks related to cybersecurity threats, data breaches, and intellectual property theft. Once risks are identified, the next step is risk analysis, which involves a detailed examination of the identified risks to understand their potential impact and likelihood. This analysis often employs both qualitative and quantitative methods to assess the severity of each risk. Qualitative methods might include expert judgment, Delphi techniques, and risk matrices, which categorize risks based on their probability and impact. Quantitative methods, on the other hand, might involve statistical analyses, historical data review, and probabilistic modeling. For example, a financial institution could use value-at-risk models to quantify the potential loss in value of its assets due to market fluctuations. The final step in the risk assessment process is risk evaluation. This involves comparing the analyzed risks against predetermined criteria to prioritize them. The prioritization helps in allocating resources effectively to manage the most significant risks first. Decision-makers must weigh the cost of mitigating a risk against the potential impact of the risk occurring. For example, a manufacturing company might decide to invest in advanced safety equipment to mitigate the risk of workplace accidents, as the cost of accidents could far outweigh the investment. A critical aspect of risk assessment is the use of statistical data and historical trends to inform the analysis. For instance, the Insurance Information Institute reported that in 2019, the insurance industry paid out $45 billion in claims related to natural disasters in the United States alone. This statistic highlights the importance of incorporating historical data into risk assessments to anticipate and prepare for similar future events. Pause. The effectiveness of risk assessment is significantly enhanced by employing various analytical techniques. One such technique is scenario analysis, which involves creating detailed narratives about potential future events to explore their impact on the organization. Scenario analysis helps in understanding the interplay of different risk factors and their cumulative effect. For example, a company might develop scenarios around potential supply chain disruptions due to geopolitical tensions, examining how these disruptions could affect production and revenue. Another valuable analytical approach is Monte Carlo simulation, a computational algorithm that uses repeated random sampling to estimate the probability of different outcomes. This method is particularly useful in risk assessment for its ability to model complex systems and account for uncertainty. For example, an energy company could use Monte Carlo simulations to assess the potential impact of fluctuating oil prices on its financial stability. Effective risk assessment also requires a thorough understanding of risk perception and communication. Risk perception refers to how individuals or groups view the severity and likelihood of risks, which can be influenced by cognitive biases, cultural factors, and personal experiences. Understanding these perceptions is crucial for risk managers to communicate risks effectively and ensure that stakeholders are aware of and prepared for potential threats. For instance, a public health organization must consider how different communities perceive the risk of a disease outbreak to tailor its communication strategies accordingly. Moreover, risk assessment is an ongoing process that requires continuous monitoring and review. The dynamic nature of risks means that new risks can emerge and existing risks can evolve over time. Organizations must establish mechanisms for regularly updating their risk assessments to reflect changes in the internal and external environment. This iterative process ensures that risk management strategies remain relevant and effective. For example, a global corporation might conduct quarterly risk assessments to account for changing market conditions, regulatory updates, and technological advancements. In practice, the implementation of risk assessment often involves the use of specialized software tools that facilitate the identification, analysis, and evaluation of risks. These tools can automate data collection, perform complex calculations, and generate comprehensive reports, thereby enhancing the efficiency and accuracy of the risk assessment process. For instance, enterprise risk management software can integrate data from various departments within an organization, providing a holistic view of the risk landscape and enabling more informed decision-making. To illustrate the practical application of risk assessment, consider the case of a pharmaceutical company developing a new drug. The company must identify risks related to clinical trials, regulatory approval, production, and market acceptance. By conducting a thorough risk analysis, the company can determine the likelihood of adverse events during clinical trials and the potential financial impact of delays in regulatory approval. Risk evaluation would then prioritize these risks, allowing the company to allocate resources towards rigorous testing protocols and compliance measures to mitigate the most critical risks. In conclusion, risk assessment is a vital process in risk management that involves identifying, analyzing, and evaluating potential risks to an organization. By employing various analytical approaches and leveraging statistical data, organizations can develop robust strategies to mitigate risks and enhance their resilience. Continuous monitoring and the use of specialized tools further ensure that risk assessments remain relevant and effective in an ever-changing environment. Understanding and implementing these concepts is essential for any organization aiming to navigate the complexities of today's risk landscape successfully. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.